Have you ever had that feeling that you lack a clear strategy or your results were too inconsistent? This video shows how traders organize their process into a rules-based system, and it's based entirely on case studies of the traders that have actually made it, regardless of their experience, trading style, and amount of free time. We'll share examples from 10 traders and perspectives from 6 experts to illustrate how a rules-based process can be more reliable than ad hoc signals. And then you may improve your trading processes just like Luke. Bear in mind, results are individual and may vary. Past performances don't guarantee future returns. This video is for educational purposes only and not to be taken as investment advice. No earnings claims and any examples are illustrative only. So let's go. In the era of AI, you can't afford 2 things: day trading and following online advice. Let's break it down. Day trading can be highly competitive and after cost, challenging for most individuals. There is always someone smarter, faster, and with more data than you. Large, market-making firms interact with significant order flow. They basically see every trade. That environment can be difficult for retail traders, if not impossible. But if you were even remotely unconventional in your approach, you'd survive that and have a chance. Now, it all changed. AI has lowered the barrier to building automated strategies. And that's where the caveat comes in. AI uses publicly available information, so all the tweets with traditional data and common knowledge strategies were immediately filled with bots. You have bots trading moving averages and bots counter-trading moving averages. Bots setting up stop losses under 5-0 levels and bots hunting those stop losses. That means the first thing you need is the data that bots don't have. It's the first brick in the wall. Sometimes that's enough. Our users Omar and Shaw were actually following a simple set of data in our sentiment map. They would visually track delta-adjusted open interest change on this nice chart and go for earnings predictions. Historically, the tool highlighted some earnings moves. Examples ahead. Omar made 4 out of 4 trades profitable, and Shaw boosted his small account by $500, which was an amazing 240% increase. By the way, none of these examples guarantee that you will be able to replicate them. Individual performances vary, as well as past results don't predict future returns. This is just an illustration of an approach where proprietary data is not in the AI research model. This open interest change dataset is based on academic research by Andy Fodor from Ohio University. That's a good and solid foundation. But is it good enough for consistent results? Let's define what a clear signal is. It has rules for when to enter and exit the trade. It has a very well-defined set of data points and values they have to display to be considered trustworthy. It also has to be back-tested to actually know what the values of that data should be. That's how we engineer the accumulation change indicator. Don't be misguided by the visual simplicity. Here's what's under the hood. We look at options contracts. The whole idea of the options contract is to say, I'm happy to pay a premium to buy a stock at a certain price before a certain date. It's very much like insurance. So what happens is, every options trade has a clear deadline, which is called the expiration date, and a clear target, which is called the strike. Then, traders pick direction by choosing a put or a call contract. And we, as a third-party observer, can see the general sentiment from the market. Lenny Dendunnen has almost 40 years of experience in financial markets. Here's what he had to say.
Seeing strike concentrations when we get close to expiration is very useful when we're trying to figure out what the direction of an individual asset or index will be over the next few days. And I've had an opportunity to look at visual sectors material, and I'm very impressed.
This data flow is quite expensive and complex, but it has a very interesting feature. Options positioning can reflect market sentiment that may at times precede actual market moves, but with no guarantee. There are 2 reasons for that. First, general sentiment defined by a group of more educated investors forms what's called the crowd wisdom effect. James Kirshner, who used to work at JP Morgan and Jefferies with 20 years of experience, described it best.
And so, one might ask, how is visual sectors doing that? They call it the wisdom of crowds. I think that's actually underselling what they're doing because, the wisdom they're extracting is not easy for others to see, and the crowd is super specific, and that's options traders. And so, what's important about options traders is that they're making bets that expire over very specific time periods, usually short ones, and they're making bets on large amounts of stock.
And secondly, it's market makers involved in the options market that have to actually hedge their positions in the stock to remain market neutral. This creates buying pressure for stocks when the demand for calls is high and selling pressure when the demand for puts is high. Here's the assessment of Michelle Philippique, who spent her career at Jefferies.
This tool generates insights based on option trade data. This approach is not entirely new to institutional investors such as hedge funds or investment banks. However, it is widely overlooked by retail investors, given the huge monetary cost to get the data and the level of sophistication required to analyze it. The folks at Visual Sectors are doing it for you.
Going back to how you can use it. Now that we know an options contract has a type, whether it be a call or a put, a target, the strike price, and a deadline, which is the expiration date, we need to define what measures of each of those create a buy signal and which of those creates a sell signal. We explore timeframes, strike dispersions, and call put net exposures. After these backtests, we selected one configuration for illustration. Early testers reported clear entry and exits and less second guessing. Luke was the first to try it out and shared a screenshot of a boost to his portfolio in the first month alone. But let's hear from him.
I realized their information is very reliable. And so as I started to use it, my portfolio started to grow. Within that trading, on the S&P 500, I gained over 15% in 1 month on my portfolio just by using their options indicator, which was correct.
Max made some incredible trades, as you can see on these screens. 9.2% capital increase in his first month alone. Max wasn't as active, but his only trade bagged him $789 in PayPal puts. Yet it wasn't perfect. The model worked well for 600 stocks, but none of the really big ones like Apple, Tesla, or Amazon actually showed promising results, both in backtests and live tests. What was missing? We decided to explore support and resistance levels based on how many puts and calls were accumulated in certain strikes or price levels. Playing around with delta-adjusted levels, based on research of course, we found a more or less consistent way to define support and resistance. Our friend Professor Ali Dadpay was impressed.
One of the things that makes me very happy about this model is seriously a step forward in our efforts to understand the connection between options market and equity movements.
It was hard. How do you even backtest a key level? How do you define when it stands or when it's broken? Support level is not a line, it's more like a zone. Price can go to $100 support and print 99.5 before bouncing back. Does that count? Does 98 count? That was just one of the challenges. Another one was what we called actionability. Imagine defining support at $50, but the stock is actually priced at $400. Who cares about this support? Yet it will show amazing backtest results. After having defined the actually actionable support and resistance levels, we then merged them with the accumulation change indicator. Olie tried these 6 trades and it worked great for him. If you think this is the end of the story and there's nothing but happy days ahead, here's one word for you: risk. Drawdowns and Sharpe ratios still weren't perfect, and there was one more market feature that we had to take into account. 2018 was the most important year in modern stock market history. It was the year when over-leverage was introduced. The Federal Reserve started monetary easing and QE that led to overinflated asset valuations. All of this started a year before COVID and was massively amplified by the crisis. Now, the way leverage works is it boosts reaction to any type of event, both positive and negative. As a consequence, the volatility floor has increased massively. Single stocks became a massive risk. In an era where equal weight S&P 500 underperforms inflation, and many analysts view mega-cap valuations as elevated, concentration risk is a consideration. And that's where a proper system steps in. We knew the signals had solid backtest and live test performance. We only needed to adjust them into an active strategy in order to manage the risk properly. This inspiration came from Jim Simons and his Renaissance Fund. We decided to go market neutral, a common approach by hedge funds to manage market exposure in volatile conditions. You can do it with fundamentals, as this study suggests, or any other set of indicators. In a nutshell, buy stocks that look stronger and are more likely to go up, and at the same time, short stocks that look weaker and you think are more likely to go down. We applied this logic to our set of accumulation change and key levels data, and here's what we got. For education only, here's one illustrative configuration of 3 simple rules. Go long 7 stocks that are close to their support level and have positive accumulation change. At the same time, go short 7 stocks that are just under their resistance levels and have negative accumulation change. Size positions according to the stock's individual volatility, and you can hold it for 2, 5, or 9 days. Wait, what was that position sizing thing? Let's have a look at 2 tickers, XLP and Tesla. XLP usually moves by 0.83% a session, while Tesla averages 3.97%. That means if you hypothetically want to simultaneously invest equally in both of these names, you're going to carry significantly more risk in Tesla, almost 5 times more in fact. So in order to be risk neutral, you would have to allocate just 17.5% in Tesla and then 82.5% in XLP. That's why we create this simple volatility calculator that provides a relative volatility comparison to SPY. This whole setup was a structured change. Max and Nail were the first to try it out. We insisted on paper trading first in order to make sure all the procedures were executed correctly and without actual risk of their capital. Both came out with remarkable results. Nail's very first pick was profitable with an annualized 43% return, while Max tested for a month, logging all of his results in this spreadsheet. He showed very strong results of 75% profitable weeks and a total of 55% annualized return. Others jumped in. Martin shared this screenshot with us. 9% return in his very first selection based on strategy rules. Not bad at all. Kyle and Najib, both being relatively inexperienced, managed to learn to execute quickly as well. Here's what Kyle had to say.
Strategy of hedging 7 shorts with 7 longs. And the way he described everything was very clear, how to look at each column in the table and figure out what makes the best sense, what I can actually use in order to turn a positive return instead of just looking at names that catch my eye, looking at Tesla, looking at Nike, just looking at big names, or just looking at things that dropped 1.4% return. It wasn't through the roof, but I was happy being able to return a positive rate without any trade knowledge.
But Luke was the true star. That's what he commented recently. $10,000 or 16% in just 1 month after adding market neutral logic to his already successful trading with our data. That's an unbelievable result, and you can be the next one we end up making a video about. Here's how Najib described it.
But what really makes this system stand out is the data and the tools they provide. Every day there's a signal by weekdays list, basically a curated set of the top 50 stocks based on detailed analysis. You don't just get the names, you get essential breakdowns like win rate, expected profit, drawdown, risk levels, and relative volatility. What I really appreciate is that it doesn't feel overwhelming. It actually made trading feel doable and enjoyable.
If you want to see how we structure it, the workshop walks through the components step by step. Join our free workshop to learn how to trade market neutral, just like the hedge fund pros. We only work with small groups of up to about 12 people to allow time for Q&A. Save your spot to see the full bill. But remember, this is an educational session only and no investment advice is intended.